Good evening, participants. Thank you for joining in to discuss the most talked of topic, that is corporate guarantee under GST. First of all, I would like to extend my heartfelt gratitude to Taxmann to provide me this platform and this opportunity to discuss about a topic that is, I think, going on, in discussions among professionals as well as industry, not more than, more than 2 years from till now. So let us just straight away dive into the topic. Why are we talking about the taxation of corporate guarantee? What is the timeline of the various significant events that has happened over the past 2 years because of which this topic has gained momentum? So this entire discussion began, it actually gained momentum at the time when a Supreme Court decision came in the case of Edelweiss Financial Services Limited. This was back in 2022. This particular decision pertained to the service tax regime, and it discussed about the taxability of corporate guarantee in the service tax regime. Since then, this question is actually coming in as to what is the taxability in GST regime? Is it similar to what was in the service tax regime? Does the decision of the Supreme Court in Edelweiss Financial Services Limited apply to the GST regime also? And all of these questions. Later, a rule was inserted. So, Rule 28 is the rule which talks about the taxability, the valuation in case of related party transaction. So there was an insertion of a sub-rule, that is sub-rule 2 in Rule 28 with effect from 26th October 23. This was subsequent to the 52nd GST Council meeting, which talked about the valuation of corporate guarantee transactions. We'll be discussing this in detail. But after this amendment, there were a whole lot of questions which came about as to the implications which would arise after this. We'll discuss that in detail. After this thing, what happened was that in the Delhi High Court, Sterlite Power Transmission went to the Delhi High Court and they challenged the very levy of GST on corporate guarantee. Later on, in the case of Acme Cleantech Solutions, also a circular which was issued along with the previous amendment, that is Rule 28.2, that circular was challenged as it sought to take away the adjudicatory powers of the adjudicating authority. And finally, as we are all aware, in the 53rd GST Council meeting, the Rule 28.2 that we're talking of was amended once again, and there was another circular which came about offering a whole lot of clarifications. So with this backdrop, let us first understand what exactly is a contract of guarantee. Now, a contract of guarantee is defined under Section 126 of the Indian Contract Act. What does it state? It states that a contract of guarantee is a contract to perform the promise or discharge the liability of a third person in case of his default. So, the primary elements which are there is that there is one person who is agreeing to perform the promise or discharge the liability of a third person in case the third person defaults. So, in case of a contract of guarantee, there will always be three parties involved. One party is the one who's supposed to perform the promise or discharge the liability to some other person, and the third person, that is the one who's giving the guarantee, will actually take up the responsibility that if the person defaults, in that case, he is going to fulfill that particular obligation. A contract of guarantee may be oral or written. So this is about what exactly is a contract of guarantee. Now, what is the exact purview of our discussion today? That is corporate guarantee. Now, what is a corporate guarantee? The example that you're seeing on screen right now is that company A is a holding company. Holding company is giving corporate guarantee to a bank of rupees 100 crores on behalf of company B, which is a subsidiary company of company A. Against this guarantee, the bank offers a loan of rupees 100 crores to company B. So what has this entire activity, the transaction of giving a corporate guarantee, actually resulted in? This transaction has resulted in company B being able to avail the loan. It may so happen that company A, being the holding company, has a better credit score. In such a case, what happens? The bank is actually giving the loan only because of the guarantee that company A has given. It may so happen that company B gets the favorable terms and conditions, or the interest rate is probably lowered. So the corporate guarantee that company A gives to the bank actually helps or benefits company B, that is the subsidiary company. So the question that comes is there any sort of a supply that is happening between company A and company B? Is company A giving any supply to company B? That is the question. And this exactly is the corporate guarantee transaction that we're talking about. Now, what happens in common parlance is that these companies, the holding company or a company which is in the group company of the one who's availing the loan, generally the one who has a better credit score gives this guarantee, and they don't really charge company or the subsidiary company or the group entity anything. So there's no consideration which is involved in these kinds of transactions in general. So there arises a question as to, is this even a transaction? So what we need to understand over here is that company B is actually receiving some sort of benefit, as we discussed, and that benefit is coming out of an activity that company A, that the holding company has done. So this transaction would definitely qualify as obviously a transaction between company A and company B. Of course, the key point being that generally corporate guarantees do not entail consideration. Now, the question that comes is, what is the taxability of this particular transaction? We'll first be discussing the service tax implication, and then we'll move on to GST. Now, the landmark decision that we were talking of when we started this particular presentation was the decision in the case of Edelweiss Financial Services. Now, what had happened in this case? The Supreme Court ordered simply that in this particular situation, because the corporate guarantee has been issued without any consideration, it is not a taxable service. If we just go a little back in the service tax regime, consideration was an important element for a particular transaction to qualify as a service and thereby be leviable to service tax. So in this case, the decision was simple, that there was no consideration involved, and therefore the issuance of corporate guarantee by the taxpayer to the group companies is not a taxable service and therefore is not leviable to service tax. But is this the same case in GST also? The answer is no. The reason is that the scope of supply under GST is governed by Section 7 of the CGST Act. GST is leviable on supply of goods and services or both for a consideration in the course or furtherance of business. At the same time, there's an exception to this. Activities Rule 1 would be deemed to be a supply even if they are made without consideration. And transactions between related and distinct persons is covered under Schedule 1. So what we're talking of, intercorporate guarantees, corporate guarantees between related parties would be covered within the scope of supply under GST because it is a related party transaction. Of course, it would qualify as a service also because under GST, the definition of services, it means anything other than goods, money, and securities. And of course, it includes activities for conversion of money. But in the service tax regime, what was the case? The element of consideration was important, which is not the case in GST. So definitely this particular transaction is qualifying as a supply. What is the classification entry? The classification entry, it would fall under 997113, which is credit granting services, including standby commitment, guarantees, and securities as a specific entry for guarantees, which would obviously include bank guarantees as well as corporate guarantees. And therefore, out of this, what we understand is from a preliminary discussion that this particular transaction would be considered to be a supply under GST, even if made without a consideration. This is exactly what we discussed, that related persons obviously also include any person directly or indirectly owns, controls, or holds 25% or more of the voting shares, or indirectly controls the other. So basically, whenever there's a group entity, what happens is the third party controls, so say the two entities. In that case also, they qualify as related persons. The recipient of supply of goods or services. So now we discussed that company A and company B, they both are in a transaction of supply wherein company A is giving guarantee for the loan taken by company B. Company A is a supplier in this particular case, and who's the recipient? In this particular case, if we refer to section 2, subsection 93, the recipient of supply of goods or services means in case where no consideration is payable, the person to whom the service is rendered. And I think it is very clear that company B would be the recipient of service. Now, after all of this discussion, the one question which would be there in the minds of almost all of us is that, is the provision of corporate guarantee a shareholder's function? Because when this entire discussion began among professionals and industry, the common question which everybody had is that, is the provision of corporate guarantee a shareholder's function? Now, let us first understand what exactly is a shareholder's function. In very common language, because it's not defined in the GST Act, in the GST law, what is a shareholder's function in common language? If we say any activity which the shareholder is doing to protect his own interest, whether in the subsidiary company or any other company, as in the capacity of a shareholder, would be considered as shareholder's function. I would repeat, shareholder doing any activity for an entity in the capacity of a shareholder to safeguard his own interest. Say it could be for expansion of his business, it could be for day-to-day running of the business, anything. That is an activity that the shareholder is giving. Now, whether we call the corporate guarantee transaction a shareholder's function or not, the most important question which remains is, will this be taxable under GST? Because the whole lot of discussion that's going around the shareholder's function is that whether this is leviable to GST or not. Now, under GST, we all are aware that there's a concept of related party transaction. So whether I'm a shareholder performing or giving certain services to the company, or a related entity giving services to another related entity, in any case, the transaction would qualify as a related party transaction. And therefore, it would constitute a supply under Schedule 1, under Section 7, and would be leviable to GST. Now, once we are through with this, that corporate guarantee transactions are leviable to GST, it is a supply. The next question comes, what is the amount on which GST should be levied, or what is the value of supply? Now, I will discuss about the situation or the position that pertained up till 25th October 2023. This is the time when the 52nd GST Council meeting amendments had not come in force. Before that, Rule 28, which actually governed the valuation rules for related party transactions, it stated that the value of supply of goods or services between related persons would be the open market value. If open market value is not available, it would be the value of supply of services of like kind and quality. Else, it would be determined as per Rule 30 or 31. At the same time, there was a proviso which stated that where the recipient is eligible for full ITC, then the value declared in invoices would be deemed to be the open market value. So all the corporate guarantee transactions that have been entered into up to 25th October 2023, the valuation rule is in front. Now, there's a lot of question that is going around, and people are saying that because there is no specific valuation mechanism, the levy itself fails. There's a very common understanding that when you don't have a mechanism to calculate the tax that is payable, in that case, the levy itself fails. And there are decisions also in this regard. But then the sole argument which remains is Even though there is no specific entry over here for corporate guarantee transactions, even then, this particular rule, which talks about taxability, which talks about the valuation in cases of related party transactions, was always there, and the value could be determined on the basis of the open market value of such supply, or of course of like kind and quality. So till here, what people were doing was either they took the amount as per the bank guarantee rates which was going on in the market, discounted by certain percentage. In fact, there are a lot of judgments from the income tax IT, wherein transfer pricing adjustments have been done for corporate guarantee transactions between overseas entities and an Indian entity, wherein the tribunal itself has held that the bank guarantee rate cannot exactly be applied in case of corporate guarantee, because in a bank guarantee there's a third party involved, there are processing charges, and there are lots of other activities which has to be done, and it is not really comparable, and that amount may be discounted by a certain value in order to find out what is the open market value of corporate guarantee transactions. But the benefit that we have in GST is, if the recipient is available for full ITC, any value that is declared in the invoice would be considered as the open market value. And this was the position up to 25th October 23. But what happened after this? After this, in the 52nd GST Council meeting, it was proposed that a specific valuation mechanism be given for corporate guarantee transactions. What you see on the left side of the screen is the Rule 28.2, which prevailed after the 52nd GST Council meeting. There was a notification that was introduced, Notification 52/23, wherein it was clarified, or actually this rule was inserted in Rule 28.2, that the corporate guarantee transaction value of supply would be deemed to be 1% of the amount of such guarantee offered, or the actual consideration, whichever is higher. I'll repeat, 1% of the amount of such guarantee offered, or the actual consideration, whichever is higher. Now, this led to a lot of questions. What if the guarantee is given for a period of 5 years? Say company A gives a guarantee of, say, rupees 100 crores for a loan taken by company B for a period of 5 years. On the other hand, company A also gives guarantee for a loan taken by company C for a period of 6 months for the same amount, that is rupees 100 crores. Are both these transactions, or are the values of both these transactions same in terms of the guarantee offered? Yes, both are 100 crores. But the period for which company B is enjoying the guarantee is 5 years, whereas company C is enjoying the guarantees for a period of 6 months. Both the valuations cannot be same. So therefore, there were a lot of questions which came out after this, that 1% of the amount of such guarantee offered, what does it actually mean? Because there's no per annum that is mentioned over here. How do we compute it? If I'm giving a guarantee for 5 years, do I have to pay 5% every year? Do I have to pay 5% at the very beginning when I'm giving the corporate guarantee? And does it remain the same irrespective of the period for which the corporate guarantee is given? What if the guarantee is given for perpetuity? What if subsequently the guarantee is revised? There's an upward or a downward revision. In that case, what would happen? So a lot of questions, actually a Pandora box of questions was opened after this particular notification came about. Then came the 53rd GST Council meeting, very recently held, wherein Rule 28.2 was proposed to be amended. I will first actually read the recommendation of the council for you in order to understand as to what was the intent. So basically, they sought to clarify the valuation of corporate guarantee. If you carefully read the press release, it's written clarification on valuation of corporate guarantee provided between related persons after the insertion of Rule 28 Sub-Rule 2. What did the GST Council recommend? The GST Council recommended, number one, an amendment of Rule 28.2 retrospectively with effect from 26th October 23, that is the date when this rule was inserted, so as to ensure that certain changes, that is the ambiguity in the language, is cleared, and there was this problem about 1% of the amount of such guarantee offered, the calculation mechanism was not clear, that could be taken care of. Also, it proposed to issue a circular to clarify various issues with respect to the valuation. Also, to clarify that the valuation under Rule 28(2) would not be applicable in case of export of such services and in cases where full ITC is available to the recipient. So, two cases where this rule will not be applicable. One, where the services have been exported, number one, and second, where the recipient is eligible to claim full ITC. So let's see the effect of this particular recommendation of the Council. Rule 28(2) has been amended by notification number 12, 2024, that was issued just 10 days ago, 10th of July, with effect from 26th October 23. What has been changed? One, this rule will be made applicable only where the recipient, being a related person, is located in India. That is one. Second change that has come about is that the value of supply of such corporate guarantee transactions will be deemed to be 1% of the amount of such guarantee offered per annum, or the actual consideration, whichever is high. There's a catch over. If you carefully notice the placement of the word per annum, it has not been put just after 1%. It has been put after guarantee offered. I will repeat, 1% of the guarantee offered per annum, not 1% per annum of the guarantee offered. How does this change the implication? We'll be discussing this in the clarification that has been issued when we discuss the circulars. So this is one thing that has to be checked. Second, a proviso has been inserted in this rule that where the recipient is eligible for full ITC, the value declared in the invoice shall be deemed to be the value of supply of said services, which was also there in Rule 28(1), the second proviso of Rule 28(1), which states that open market value will be the value declared in the invoice will be deemed to be the open market value. And in this case, the value declared in the invoice shall be deemed to be the value of the said supply of services. This is the change that has come about. If I just summarize the entire value of supply rule in this case, one, this valuation rule is applicable for corporate guarantee given where the supplier and recipient are related persons and the recipient is located in India. The corporate guarantee must be given to a banking company or a financial institution. Third, the value of supply shall be deemed to be 1% of the amount of such guarantee offered per annum, or the actual consideration, whichever is higher. If the recipient is eligible for full ITC, value declared on the invoice shall be deemed to be the value of supply of said service. Now let's come to the clarification that have been issued by this particular circular, Circular 225. We'll just go one by one as to what were the questions that were answered. First of all, is Rule 28(2) of the CGST rules applicable with effect from 26th October 23, or does it have a retrospective application? Why did this question come about? Because when this particular rule was amended, there was this doubt among people as to whether the corporate guarantee transaction was supposed to be taxed at 1% since the very inception or not, because there was no specific mechanism. So the circular has very clearly clarified that whichever corporate guarantee has been issued prior to 26th October 23, in that case, the valuation rules as per Rule 28 has to be adopted. That is 28(1) that we read as of now. If the corporate guarantee is issued after 26th October or renewed after 26th October 23, in that case only will Rule 28(2) be applicable. What we need to understand is that after insertion of Rule 28(2), the taxability has not changed. the particular transaction was taxable even prior to insertion of Rule 28.2. Rule 28.2 has only provided a valuation mechanism. Taxability of corporate guarantee, definitely it was there prior to this rule also, and subsequently also, just the valuation mechanism has changed. The second question was, what would be the value of supply of corporate guarantee where the amount of loan is less than the amount of corporate guarantee? I'll just come back to the rule once in order to understand why this question even came up. If we carefully look at the language, it is talking about the value to be 1% of the amount of such guarantee offered. It's not saying the amount of loan taken out of that guarantee, right? So therefore, guarantee offered very clearly states that this is the amount that company A, being the holding company, has offered for company B. Say, for example, the amount of corporate guarantee is 100 crores, but actual amount of loan disbursed is, say, 70 crores. In that case, what will be the value of supply? Value of supply will be 1% of that 100 crores. Now the question comes is whether the recipient is eligible to claim ITC of the entire 100 crores because he has only taken loan of 70 crores. The circular has clarified that yes, ITC eligibility does not depend on the loan amount. It depends on the amount of guarantee offered. Next is GST applicable on corporate guarantee in case of takeover of loans, since it's merely an assignment. So basically what happens is, say the loan has been taken from bank A, but subsequently the loan gets assigned to bank B. In that case, what has happened? Simply the lender has changed. The person who has issued corporate guarantee, the surety remains the same. The person who's getting the benefit of the corporate guarantee, that is the recipient, remains the same. The amount of corporate guarantee remains the same. The tenure of the corporate guarantee remains the same. In such a case, since there is no transaction, no issue of fresh corporate guarantee, there will be no GST implication in takeover of loans or assignment of loans. But if the situation is that there is a fresh guarantee which is issued or the guarantee gets renewed, in such a case, definitely on the renewal portion, GST would be leviable. The next question which has been clarified is in cases where the corporate guarantee has been given by more than one entity. That is, when there are more than one guarantors. It may so happen that one entity is taking a loan, but then the group entities, say 4 of the group entities, are providing corporate guarantee for that loan taken by the entity. So in this case, there are two situations. One, in case of a consideration, if the consideration paid to the guarantors, the total consideration paid to all the guarantors exceeds 1% of the guarantee offered, then the value of supply will be the actual amount that has been received by each guarantor, which is very simple. But in the other cases where the amount of consideration is less than 1%, in that case, proportionally, we have to calculate 1% of the guarantee offered by each co-guarantor. So say there's a loan of 100 crores for which 4 guarantors have given corporate guarantee equally. In that case, since all of them have given guarantee of 25 crores each, the value of supply for each of them would be 1% of such 25 crores. But what happens is, in a lot of situations, the loan amount is 100 crores, but the bank receives guarantee of 100 crores each from 4 different entities. In that case, the total amount of corporate guarantee actually becomes 400 crores. And accordingly, each and every co-guarantor would be liable to pay GST at 1% of the amount that they have offered. Of course, if there is no ratio given and the co-guarantors have jointly given a corporate guarantee and there's no ratio, then we have to take equal proportion. The next question is whether intra-group corporate guarantees are liable to RCM or forward charge. So it's a very simple question whether the intra-group corporate guarantees are liable to RCM or not. So in this case, whether supplier and recipient are both located in India, In that case, forward charge would be applicable and the supplier would be liable to issue tax invoice. But where the supplier is located outside India and the recipient is located in India, such transaction would fall under RCM. This we'll discuss subsequently also. The most interesting part is this. What is the periodicity of computation of 1% of the guarantee offered? Now, as we read, the change has come 1% of the guarantee offered per annum. What does this mean? This means that if the corporate guarantee amount is 1 crore and it has been offered, say, for a period of 5 years, in that case, we have to pay 5% of 1 crore at the time of issuance of corporate guarantee. So what is it? 1% into 5 crores into 5 years. That is what the computation is. It is not that each year you pay 1%. We actually calculate the total number of years, the total amount, and then we apply 1% on that. So the example was also given in the circular itself that corporate guarantee given for 1 crore for 5 years is 5% of 1 crore. Of course, there's an option over here in case the corporate guarantee is say given for 1 year and subsequently renewed 5 times every year. In that case, we'll have to pay 1% each year on that 1 crore rupees. Now, the question is, can this kind of an adjustment be done, or can this kind of a tweaking in the contract be done in order to ensure that we are paying GST every year rather than paying it at one go? So, well, what happens is when the bank is giving loan and the tenure of the loan is 5 years, generally the bank wouldn't accept a corporate guarantee given for 1 year and then subsequently renewed every year, right? So accordingly, this is what the periodicity is, and whatever tenure is actually mentioned in the guarantee letter, in the contract of guarantee, that is the basis on which this computation of 1% of guarantee offered would be done. The next question which comes is the benefit of second proviso of Rule 28(1) not applicable for corporate guarantee? So we've already seen that the amendment has already come in Rule 28(2) and a proviso has been inserted which specifies that supply of corporate guarantee between related persons where the recipient is eligible for full ITC. In such cases, the amount declared on the invoice will be considered to be the value of supply of corporate guarantee. The next question which comes is whether the valuation in terms of Rule 28(2) will apply to export of services or not. Then, of course, this has also been made clear that Rule 28(2) will not apply to export of service. This also we'll discuss subsequently here. Actually, what question arises after Rule 28(2)'s amendment is that if this particular rule is not applicable for export, does it mean that we're not supposed to pay GST on export of corporate guarantee services? Well, the answer is no, because in that case, we have to apply the valuation as per Rule 28(1). Because in the recommendation also of the GST Council in its 53rd meeting was that the export of services, wherever corporate guarantee services are being exported, over there, they don't want Rule 28(2) to be made applicable. So the rate is not fixed, but open market value will have to be considered. Now, the next question comes is whether this particular transaction would constitute an export of service or not in the absence of a consideration. Why? If we look at the definition of export of services, then there are certain conditions that have to be fulfilled for a transaction to be an export of service, wherein one of the conditions is that the payment for such service has been received by the supplier in convertible foreign exchange or Indian rupees wherever permitted by RBI. Now, what is happening in this case where there is no transaction, when there is no consideration involved at all? In such a case, will a transaction still constitute an export? So, well, there's an argument that can be taken over here that where a condition itself is not applicable, in the absence of the applicability of a condition, we can say that it is deemed to be fulfilled because it's not applicable at all. So in that case also, we can argue that it is still an export of service and we should get the benefit of export of services. The next point comes is import. Wherever we are importing services, that is where the supplier is located outside India, the recipient is located in India, and the place of supply is in India, would constitute an import of service. In such cases, tax is liable to be paid under reverse charge by virtue of notification 10/2017 integrated tax rate, which states that any service supplied by a person who's located in non-taxable territory to a person other than non-taxable online recipient could be liable to RCM. But after the amendment that has come, if the recipient is eligible for full ITC, then whatever value is declared in the self-invoice that the recipient raises would be considered to be the value of supply of corporate guarantee services. What is the time of supply of corporate guarantee services? There's a confusion that this should be considered as a continuous supply of service. Well, after the circular that has been issued recently, this thing has also been made clear because they've actually mentioned very clearly that 1% of the amount of guarantee offered per annum would actually mean that the entire amount into the number of years into 1% that has to be paid at the time when the corporate guarantee is given. But where is this coming from? From the GST law. So if we refer to the time of supply provisions, in that case, wherever there is no consideration involved, section 13, subsection 5 is supposed to be applied. And what is that? The time of supply shall be in case where a periodical return has to be filed, the date on which such return is filed, and in any other case, the date where the tax is paid. And there was a banking sector FAQ also, which was issued by the CBIC, where it was clarified that when there is no invoice that is being raised and no payment is being made by the recipient, and there's no entry also in the books of accounts of the recipient of service, in that case, time of supply shall be the date when such cost is determined or when the certificate is received and the GST liability is discharged accordingly. So in our case, where we are dealing with a corporate guarantee transaction, in such a case, the date when the guarantee has been given is the date when the costs are also determined, and that is the day where the time of supply provision actually triggers and kicks in. So that is the day when GST becomes liable to be paid. Now there's an open question which remains, whether, which we discussed also, whether corporate guarantee was taxable prior to insertion of Rule 28(2). Yes. But what if somebody has not paid GST on corporate guarantee? This particular question has not yet been answered in any clarification. But what we can understand is, number one, it is taxable. It was taxable also. So right now, taxes can be paid with applicable interest, and the recipient would be eligible to claim ITC because the invoice date that the supplier will issue, the invoice date would be current date. So of course, section 16(4) would also not get triggered, and tax would be paid along with interest, and ITC will be eligible. But in case where full ITC is available to the recipient, which may happen in a lot of cases, but the supplier has not issued an invoice and has not paid tax on the corporate guarantee services, in that case, there is a reference that we can draw to Circular 199, which was issued in case of transaction between distinct persons, or Circular number 210, which was issued very recently. And we may assume that the value is nil for that particular transaction because the ITC is available to the recipient. Now, this particular case has not been specifically dealt in either of the two circulars, but we can draw an inference out of it based on the premise that the intent of the government is not to unnecessarily tax a transaction where the recipient is eligible for full ITC. It would actually be a revenue neutral situation where the recipient was eligible for full ITC and the supplier has not charged GST. In that case, we can take this argument that the value of supply was nil and accordingly the invoice was not issued because that is considered to be a nil value, or the value of supply is deemed to be nil. So this is one thing that can be done now. The next point that comes is, what is the impact of corporate guarantee revisions? Now, what happens is, at times, the holding company has they given a corporate guarantee of say 100 crores for a period of 5 years. But subsequently, after say 5 years, the amount one the company, the subsidiary company requires further loan. In such a case, what may happen is the corporate guarantee may be revised. There can be two types of revision. One, the value can be increased. Two, the period can be extended. That's just like renewal of corporate guarantee. In that case, what will we have to do? First point, where the amount has been increased, GST would be liable to be paid on the differential value. Let's take the example. Corporate guarantee was given for a period of 5 years for 100 crores. After the end of the third year, say for example, after the end of the third year, the amount was revised to 150 crores. So the corporate guarantee that has been given additionally, that is 20 crores for a period of 2 years, would become the amount that would be liable to GST, and 1% would be liable to be paid on such amount, that is 50 crores into 2 years into 1%. Now, in case where the increase is only an increase in the period, that is a renewal of corporate guarantee, in such case, GST would be payable on the entire value for the extended period. That is 100 crores for 5 years was the original guarantee. Subsequently, it was revised to 150 crores for a further period of say 5 years, or 100 crores for a further period of 5 years. In that case, what will happen? The entire amount would be taxable under GST for the extended period. This is a simple case. But what happens when there is a downward revision? Originally, the corporate guarantee was given for 100 crores for 5 years, which was subsequently revised downward after, say, the end of the third year and reduced to 70 crores. Now, what has happened in such a case? In the beginning, we have paid GST 100 crores for 5 years. But now the situation is the corporate guarantee has been revised to 100 crores for 3 years and 70 crores for 2 years. So technically, we have paid extra GST or excess GST on 30 crores for 2 years. So in that case, we need to actually explore the option of claiming a refund, because in such a case, the service has not yet been provided. And this is one area where future litigation may arise, because there's no such clarity on this particular aspect. And obviously, future litigation may arise and the refund may not be as easy. But of course, the case is very clear where the amount of guarantee has been reduced and the recipient is actually not enjoying the benefit of the increased amount of guarantee for a certain period of time. In that case, we may explore the option of refund. Now let's come down to what is the way forward. Out of all the discussion that we've had till now, one thing is clear, that corporate guarantee transactions, as per the present scenario, the intent of the government, the circulars that have been issued, is taxable. But there are two case laws and two ongoing cases which are pending. One, filed by Sterlite Power Transmission Limited. This is before the Delhi High Court, wherein they have actually challenged the very levy of corporate guarantee, and they've actually filed a writ petition seeking a declaration that the activity of holding company that is providing a corporate guarantee to subsidiary is not actually a taxable service. It is not a supply at all under Section 9 of the CGST Act. So over there, the petitioner submitted that this particular case actually is a contingent contract, and this would be enforceable only when there will be a default. So as such, there is no activity or there's no supply that the holding company has done for the subsidiary company. Simply that particular activity will be done actually when there will be a default by the subsidiary company, and the holding company would be liable to pay on behalf of the subsidiary company. Until then, there is no supply, and this is merely a contingent contract. So this is their argument. And as of now, they have received a stay from the Delhi High Court, and that is what the situation is right now. Let's see where this decision will go forward. And I'm sure that probably this is a matter that will go up to the Supreme Court until the issue is settled. But as of now, till now, at least, the taxability has been made very clear by the government side. The second case is Acme Clean Tech Solutions Private Limited, wherein the petitioner filed a writ petition before the Punjab and Haryana High Court. They have actually challenged circular number 204. This is the circular which was issued along with insertion of Rule 28.2 back in October 23. And they are saying that this is the circular which has actually tried to take away the adjudicatory powers of the assessing authority and the appellate authority, and therefore it is ultra vires, and this is something that cannot be issued and it will not stand the test of law. So an interim order has been issued by the court, and they've said that the impact of this particular circular should be stayed until the further hearings are done and the case is concluded. Until then, the appellate authority have been allowed to actually adjudicate the case without being influenced by this particular clarification. So these are the two open cases which are still pending before the courts of law, and let's see the situation which may arise after these decisions are actually pronounced, and maybe we can expect certain changes coming in. But of course, till now, the taxability is clear, the intent of the government is clear, and so the advice to everybody would be that we must continue paying tax, GST on corporate guarantee, because see what will happen is at the end, say for example, after a decision comes, say from the Supreme Court, and the levy is quashed. If at all this happens, in that case also, because that particular transaction of corporate guarantee would become not leviable to GST subsequent to an order of the Supreme Court or a decision, we can claim a refund of excess taxes paid. So in such a scenario, it is ideal that we pay taxes. If there are earlier periods where the taxes have not been paid, it is ideal that taxes be paid, because of course notices would be issued by the department, and this is something that would be adjudicated as per the rule and the circular that has been issued. So that was about corporate guarantee. And I think if we have questions and if we have enough time, we can take some questions. Okay, so there's a question. GST tax on corporate guarantee under RCM. Can we take GST ITC against it? Kindly clarify. Yes, definitely. If we have paid GST under RCM, we can take ITC of that, subject to fulfillment of all other conditions of taking ITC. Guarantee given for bank guarantees issued by bank on behalf of related party to any customer of related party is also considered as corporate guarantee. I'll just read it again. Guarantee given for bank guarantees issued by bank on behalf of related party to any customer of related party. Okay, so in this case, what I understand is there are four parties involved, wherein there is, say, the holding company has given guarantee to its banker. The banker has given guarantee to, say, the branch of the bank, say, located in India, and the other was located outside India. And that particular bank has given loan to the related party, that is a subsidiary company. Of course, this would also be covered under corporate guarantee. And yes, the taxability would remain the same as we have discussed. Prospective or retrospective difference with GST corporate guarantee. I think what this question means is that wherever, I mean, this rule 28.2 that has been amended retrospectively. So the only difference is that earlier, since after 26th October 2023, the valuation mechanism is prospective, and the recent change that has come in, that is retrospective. So eventually the effect would be that the current rule that is prevalent is effective from 26th October 2023. I hope that answers this question. The next is, if the principal debtor is in the business of natural gas and its holding company giving corporate guarantee on behalf of its subsidiary, is subsidiary or principal debtor available? Okay, so simply wherever you are into a business where you're providing exempt supplies, then of course, if your entire business is exempt supplies, in that case, you will not be eligible to claim ITC. Right. Ma'am, you're referring to circular number 199, but it refers to distinct person. But will it cover subsidiary? Will the shelter be still available? Circular deals with only for imports. The department may not accept this. Yes, of course, circular number 199 deals only with distinct persons. But if we refer to circular 210, that also has taken reference of circular 199 and stated that the benefit would be extended to related persons also. And although this is not really covering our scenario, but as I mentioned, we can take an inference out of that and say that the intent of the government was this only, that wherever full ITC is available, in that case, it's a revenue neutral situation, and therefore the benefit that these two circulars provide has to be given to and extended to corporate guarantee also. Of course, the department may litigate it, but then what I believe is that it would actually stand well in the court of law, considering that the circular clarifies the intent. One more issue cropping is with income tax, as we are now showing as supply and holding without actual sale recorded in holding company. There are mismatch with GST return as per AIS and financial statements. Okay. So, of course, I mean, income tax, I'm not sure as to what exact issue is coming up with income tax, but yes, definitely this may lead to a mismatch between the GST returns, and because this is not something that is recorded as an income as such. And in fact, it is recorded as a contingent liability in the books of accounts. But yes, that has to be explained to the department. What will be the taxable value before 26th October 2023? The taxable value before 26th October 23 would be as per Rule 28.1, and that will be the open market value. So we have to actually calculate the open market value wherever full ITC is not available to the recipient, and that can be done by actually checking the bank guarantee rates which are applicable, and appropriately discounting such an amount. If full ITC is available, then whatever value you declare on the invoice would be considered as the open market value. Can you clarify the impact of personal guarantee by related individual to form of partners? So basically, what I understand is that in the earlier circular also, it was mentioned that guarantee given by directors is not leviable to GST, but personal guarantee would also get covered in this case, because we are talking only of related persons. If you refer to section 28, if you refer to rule 28.2, it talks about corporate guarantee given on behalf of related person. So wherever there's a related person, irrespective of whether it's in the form of a company or an individual, it would still apply, in my opinion. Please repeat time of supply. So time of supply has to be referred to as per section 13, subsection 5, which governs the cases wherein no consideration is involved. Of course, I'm dealing right now with cases where no consideration has been involved. If there's consideration, then it has to be appropriately checked under section 13. But yeah, so it states that wherever a periodical return has to be filed, the date when the return is to be filed, that is supposed to be the time of supply. So in this case, what will happen whenever we are giving the corporate guarantee, that day the time of supply provision gets triggered. And there's a clarification also that has been issued by CBIC in the form of an FAQ for banking companies, which when you get the slides, you can also refer. Where non-core company have nil revenue provides corporate guarantee to a bank on behalf of company registered under GST. whether non-core company need to raise tax invoices. Currently, non-core company is not registered under GST. What do we exactly mean by non-core company? But in any case, what I understand is that if the company who is giving guarantee is not registered under GST, in that case, what will happen? We'll have to see if the turnover crosses 20 lakhs. In that case, the company will have to take registration under GST because it's a taxable supply. Can you repeat the case law referred for the argument that bank guarantee rate cannot be directly taken as open market value for corporate guarantee? So this was an IT80 decision, if I'm not wrong, of Tega Industries. When I share the presentation, I'll also mention that particular case law, Tega Industries IT80 decision. If I'm not wrong, I'll have to actually cross-check once. And over there, it was said that the bank guarantee rate does not need to be considered for corporate guarantee. It can be discounted. But I'll have to check the name of the case law and I'll share it along with the presentation. I'll just check if there are any more questions. Can we raise an invoice on current date for 2 years old corporate guarantee and opposite party gets ITC? Yes, of course, you will just have to pay interest on the delayed payment of tax, even if it's an old service, even if it was provided 2 years ago. In that case, also, in fact, the value of supply would be as per the 28(1), and I think that clarifies. All right. That's it. I think there are no more questions. Thank you so much to all of you for being such a lovely audience. Thank you. Thank you, Taxmann.